In this last section, we'll try and identify where to find value in fixed income. Ted, this month PWM conducted the third global asset allocation survey tracking the investment decisions of 40 global and regional private banks, which manage more than $10 trillion in clients' assets. And results from the survey showed that 90% of the private banks have a tactical underweight position to fixed income. It hasn't really stopped you from launching new products. You recently launched the Spider Barclays Global Aggregate UCITS funds.
Yeah, and obviously the current market environment isn't necessarily as favourable to fixed income as other periods, but something the Barclays Global Ag, in our sense on that particular launch, that's a long-term holding. I mean, we see a lot of big institutional clients, pension funds, etc., who will allocate to that benchmark because they've got a lot longer time horizon to be able to hold that. And launching it at something like 10 basis points, it's a long-term cost-effective solution. So our sort of two big calls that we're speaking to clients about at the moment are emerging market local debt and global convertible bonds, because we still feel they add attractive returns to a portfolio for a number of reasons. So that's our main sort of focus at the moment.
In terms of fixed income ETFs, I think they're very similar to what Ted mentioned. I think emerging market debt, local debt especially. But looking at other risk asset classes, I think high yield, again, we've talked already about a pretty benign default rate environment, and likewise for credit. If this global growth story continues and before monetary policy tightening kind of causes a shift, more tightening of financial conditions, should all be good for spreads. Carry is the trade. There'll be no huge price appreciation apart from possibly from convertible bonds and from emerging market local debt. And the local debt will be driven again by if this weak dollar continues. If we have the Secretary of the Treasury talking about liking weak dollar, it influences these things, and it could happen, it could continue to happen and benefit the asset class in a price. But every other fixed income sub-asset class, it's really about carry this year.
But EM local debt is not something that you used
we do
ETFs, in the ETF space?
We would if we couldn't find a manager that we preferred and an active space, and we're pretty, it takes a while to find an active manager that you're happy with, but we are happy with our one at the moment, and that's why we wouldn't. Again, previous years we would have tactically gone in for maybe 4 or 5 weeks, but you can't really do that with an asset class like this. It's so expensive, the spreads are so wide, and it's not one of those things that you can suddenly buy this ETF and sell it the next day. So this is why we kind of hold fire, find your active manager, and then invest that way.
I think at the moment the big problem is most of fixed income looks unattractive, just different shades of unattractive. So I think it's going, and everyone at the moment is trying to, how do you get fixed income without getting fixed income? So it is through things like emerging market debt, through taking advantage of credit, and that way we're doing something similar, short-dated credit, where the pull-to-par effect limits your broader exposure and you get some sort of return. I think those parts of the market, until you see fixed income markets, so sovereign yields move materially higher, is probably where a lot of interest is going to be. Looking through the course of the whole year, I'm not sure we're there yet, but I think if you see, just throwing numbers out there, but if you see US 10-year treasuries start getting closer to 3, I think a lot of people, that's the magic number. And then I think broadly you'll see a lot of people flowing in there, which probably means it will never quite get there. And as always happens, it will tick up, but not quite hit that point. But I think if you do see that happening, and as we see QE programs being withdrawn, see some term premium get in, I think a lot of people will get more interested at that point. And then I think a lot of people will be buying treasuries through ETFs.
I think just in terms of growth, because we're still at the adoption phase within fixed income ETFs, and we're still at the rapid growth phase, 20+% growth per year, it will probably be the case, just as last year, it will be the larger parts of the market that will attract the most flows, so the investment grade, government, and the broad stuff, because those are the biggest parts of the market, and because we're selling acts on the whole, people are selling active and buying passive. They'll do that in that sort of prorated way. In terms of our views, which is maybe a separate thing, we like EM hard currency as really for 3 reasons. I think we think commodity prices remain stable, which is significant for emerging market debt. We think global growth, continues to be impressive and buoyant. And also we think there's probably a bit more value in emerging market hard relative to developed market debt. especially when you allow for the different levels of leverage. We have a manager that we like in that space, but we would certainly use ETFs in that area if we wanted to increase our tactical position or at different times in the cycle.
I see larger inflows going into fixed income this year. As the returns are lower, investors will be seeing costs and taking that into higher, more consideration, and particularly where the KID documents now have to do the transaction costs and any swap costs as well. So for an active fund and investment trust, they can be quite significant. So investors don't mind paying costs while they're seeing growth, but once that growth reduces, they will be taking account of all the costs, and particularly because now their valuations are given an underlying cost of everything they hold. I think that will be adding inflows to the ETF market. In the fixed income, I mean, you can get some really cheap ETFs now for 7-9 basis points. I'd still think there's some improvement to be made by some ETF providers, particularly on fixed income costs, but they're cheap.
I think currency hedging is huge. I think, obviously we've seen a lot of currency volatility over the last, few years, and I think, generally people in fixed income do tend to hedge their portfolio anyway, but I think more and more so with ETFs, people are going to demand currency hedge ETFs, especially for sterling investors at the moment.
I guess from a flows perspective as well, we should bear in mind we're talking about what we think flows will be based on a consensus position, but you don't go through many years holding a consensus position. So I think there's definitely the opportunity to see, a risk-off event in 2018 at some point, what the catalyst will be. I wouldn't like to stake money on, but I think that, in that event, you're going to see some very different flows to potentially what we're talking about now. So, for us, that would maybe look a lot like adding, some long-dated duration into the portfolio, particularly probably long-dated treasuries as protection, somewhere you're going to get a lot of bang for buck quite quickly from a duration perspective.
Yeah, there is an awful lot of consensus in terms of market views out there at the moment, and that implies that positioning is probably relatively similar. And if something comes around, then you want to have moved a little bit ahead of that, so that you're not trying to trade at the wrong time. But that's the challenge.
Oh, we are going to host another roundtable discussion at the end of this year, so we'll see whether these predictions will come true. But thank you very much for this interesting debate and for your interesting insights, and thanks very much for coming. Thank you.
Thank you.